Hi there. Today we'll start a new part in our course. And just before we start the intercompany transactions, we need to have a quick overview of what we covered so far in the course. If you remember, we were talking about the consolidation in the financial statements between the parent company and the subsidiary. And we were talking about 4 different scenarios. First, if a parent company is owning 100% of the subsidiary, and the book value of the subsidiary is equal to the fair market value. In this case, we used to make the consolidation in the financial statements by giving all the equity to the parent company, and then start consolidating the income statement, retain the earnings, and balance sheet. And then we talk about the parent company, which is buying a controlling interest between 51% and 99%. And the book value is equal to the fair market value of the subsidiary. And in this case, we start to get a new account. We call it NCI, non-controlling interest. And we have seen how to do the consolidation in this situation. In chapter 4 and 5, we were talking about also consolidation between the parent and the subsidiary, where the parent is owning 100%, but the fair value is higher than the book value of the subsidiary. And in this situation, we start to see a goodwill, which is the increase in the value of the company. And at some point, we had the increase going to different accounts like inventory or equipment or other intangible assets, or we could put the increase in the goodwill. And in the last chapter, we have a consolidation between a parent company that has controlling interest and a subsidiary company, where the fair value of the subsidiary is higher than the book value. And again, we start to see the NCI and the consolidation between the two companies. Starting from this chapter, we will talk about another topic, which is the transactions that could happen between the parent and the subsidiary, either in the current assets like inventory, and this is what we will see in this chapter, or fixed assets, which we will see it in the next chapter, or long-term debt like bonds payable or loans. But we will not cover the long-term debt because of the shortage in our course. But if you would like to know more about this topic, you can go to chapter 8 in the textbook. And with this in mind, let us go to the presentation and then take a few examples on that. So, as I said, like here we see that in chapter 4, we were talking about some intercompany transactions like accounts receivable and accounts payable. And we had this consolidation journal where we used to debit accounts payable and credit accounts receivable to close off this transaction. But in chapter 6, we will talk about another current assets like inventory. And here we will see that the parent company might sell inventory to subsidiary, which we call it downstream transaction, or the subsidiary will sell inventory to the parent, which we call it upstream transactions. We will talk about both ways, and we will see how to make the journalization for both of them and the consolidation in the financial statements. In the next chapter, we will talk about buying and selling fixed assets. If we move one fixed asset from the parent to the company, what should happen, and how we calculate the depreciation. So, what we need to eliminate when the intercompany transaction happens, we need to eliminate the internal journal entries, which means whatever happened between the parent and the subsidiary. But if the parent is buying inventory from another supplier, making some kind of production, then selling the inventory to subsidiary, and then the subsidiary will sell it to the final customer, anything between the parent and the subsidiary that should happen needs to be eliminated. So if the transactions happen between outsider, like supplier or customer, and the company, this arm's length transaction should be recorded. But the internal transaction, which we call it related party transaction, should be eliminated. And good example for the related party transaction is open account balance or security holdings or sale and purchase of inventory or interest or dividends. There is no distinction here whether the parent is buying or acquiring 100% of the subsidiary or less than 100%. We should eliminate the intercompany transaction regardless of the ownership percentage. And here, if the parent company is giving or taking a loan from the subsidiary, so for example, the parent is giving a loan to subsidiary $500, we can close off this intercompany transaction by reversal, which is similar to what we have seen in the previous chapter. We used to say debit accounts payable, credit accounts receivable. Here we can say debit loan payable and credit loan receivable. The principle is the same. And as I said, if you need to know more about the loan transactions, you can go to chapter 8 in the textbook. But what about if the parent is buying inventory and then selling the inventory to the subsidiary, who will sell it to an outsider final customer? So we assume here a parent is buying inventory for $250 from an outsider, and then selling the inventory to the subsidiary, which will sell it eventually to a final customer, which we call it outsider. So here the product comes from an outsider and goes to outsider. Anything that has outsider involved in the transaction should be recorded in the financial statement. But anything in between the parent and the subsidiary should be eliminated like this one. So we will keep the 250 at the end of the day. We will keep the 500, but we need to eliminate the $400 because this one we call it related party transaction. So the parent will keep the cost of goods sold, which is 250 here, and will keep the final selling price, which is 500, and we will eliminate the $400 here. And of course, we get rid of the cost of goods sold for the subsidiary, but the parent cost of goods sold and the subsidiary sale, we call it arm's length transaction that should remain in the financial statement. And here we go to the other one where we can make the journalization. And before we go through the journal entries, I need to explain the difference between two inventory systems that you might have covered in the previous classes of accounting. One, we call it perpetual inventory system, the other one periodic. In brief, the difference between the two systems is the calculation of the cost of goods sold and the accounts for the inventory. If we use the perpetual inventory system, we have to calculate the cost of goods sold in every sale transaction. And this is the reason we start from now. Whenever we make sales, whether the sales goes from the parent to subsidiary or subsidiary to outsider, whenever we sell product, we have to make two journals. One for the selling price, one for the cost price. The second difference between perpetual and periodic, in perpetual, we use one account for the inventory, which we call it inventory or merchandise inventory. So whenever we buy inventory, we put it in inventory. Whenever we sell inventory, we take it from the inventory. If we use periodic, whenever we buy, we call it purchases. And whenever we return to the supplier, we call it purchases return. Whenever we take discount, we call it purchases allowance. And if we take extra cash discount, we call it purchases discount. So we have multiple accounts. We use it for the inventory. But here in this chapter, we use perpetual in all the examples. And because of that, you will notice that we calculate the cost of goods sold and we use one account for the inventory. So when the parent company is selling to the subsidiary, we make two journals. One for the selling price, we debit cash, credit sales, And one for the cost of price, we debit cost of goods sold, credit inventory. And whatever the parent is considering as sales, the subsidiary will consider it as purchases, where we debit inventory and credit cash. So you can see here that the same amount that has been used in sales have been used in purchases. And when the subsidiary company is selling the product to an outsider, we use the same set of accounts, but different amounts. So here we debit cash, credit sales, as we did here, but here the price is higher. We debit cost of goods sold here, but the cost of goods sold is the same selling price that came from the parent. And here we ask, what are the legitimate transaction? The legitimate transaction is any transaction that has outsider involved in it. So for example, when we make here the cost of goods sold inventory, if you remember, this is the original cost that came to the parent, and the final sale is the final sales amount that goes from the subsidiary to the customer. For those two accounts or two journal entries, we have to close them off. How? We reverse the journal, so the sales here will be debit and the cost of goods sold will be credit. And remember, we don't close the assets, so cash and inventory are assets. We don't close them, but we close the income statement accounts, which is sales and cost of goods sold. So here the cash 400 and here 400, they offset each other. Inventory 400 and inventory 400, they offset each other. And then we have the sales amount here will offset the cost of goods sold. And finally, we debit sales, which comes from the parent to the subsidiary, and cost of goods sold from the subsidiary to the outsider. So please remember this journal, because this is what we need to do at the end of the day. How about we make sales from the parent to subsidiary, but it doesn't go to the outsider? Why? Because maybe the subsidiary got the inventory on the last day of the year, and it remained in the warehouse of the subsidiary until the next year. Or we get huge quantity from the parent in 1 year, which we couldn't sell in the same year, so we kept some in our warehouse of the subsidiary company until next year. What shall we do here? First, we do the parent, I assume, purchase for $200, made sales for $300 to the subsidiary, and then it gets stuck here. So we keep the original purchase as we did, but we need to eliminate the intercompany transaction as we did. So we debit cash, credit sales by the selling price, debit cost of goods sold, the credit inventory by the cost price for the parent. And the subsidiary will record the purchase here. And we need to do the closing entry. How we make it? So we have the cash here, 300, and we'll offset the cash 300 here. But the sales 300 will offset the cost of goods sold 200, and the difference between them, which is 100, will go to the unrealized gain. But since we don't have unrealized gain in this situation, we put the inventory account. So we say debit sales by 300, credit cost of goods sold by 200, and the 100 difference should be unrealized gain. But because it's intercompany and doesn't go to the outsider, I cannot call it gain. But we put it in the inventory temporary until we sell it to the outsider. Then we can recognize the gain. So this is for the net. So now let us take a quick look on the journal entries that we discussed so far. We say number one, we close off the loan by debiting loan payable, credit loan receivable. Then we close off the intercompany account if the product has been sold completely to the outsider and there is no unrealized gain, and elimination if we have unrealized gain. So we will go through 3 examples in this video, and we will see how can we make these journal entries and the consolidation in every example. So with this in mind, let us go to the Excel file. And by the way, those exercises, you will be able to see them in bright space. As I did in my previous videos, I encourage you to read the exercise, put my video on hold, try to make your own answer, and then come back to compare your answer with mine and see where are the discrepancies. So here we see in the first exercise, there is a parent company that purchased 90% of a subsidiary company. And after a few years, the parent company purchased 57,000 units for a cost price of $25. And then sold 42,000 of them to the subsidiary for $31. So you can see that the parent purchased the unit for 25 and sold it for 31. Before the end of the year, the subsidiary sold the whole quantity of 42,000 units. So we need to know how can we make the journal entries for the parent. And here we have to make the first journal for purchase, and then the second two journals for sales. And since we use perpetual inventory, we make one journal for the selling price and one journal for the cost price. Then we need to do the journal entries for the subsidiary company here, which first include the purchase from the parents, and then two journals for the selling to the outsider. And finally, we need to do the consolidation entry. So here we see the first set of journal entries. As I said, the parent purchased 57,000 units times $25. We get $1,425,000. So we debit inventory, credit cash, or accounts payable, because it didn't say literally whether the company made the payment or its own credit. So we put both account, and that should be fine. So this is the first situation when the parent purchased the inventory from the supplier. Then the second situation when the parent sold some of the quantity, which is 42,000 units, at a higher price to the subsidiary, $31. We make two journals, one for the selling price and one for the cost price. We debit cash, debit accounts receivable, credit sales by the selling price. And then we debit cost of goods sold, the credit inventory by $1,550,000. And here you might wonder, why did I highlight or I made sales in bold? Because if you remember from my slides, that this is the first account I should take it to the consolidating entry. Because this one is credit, I will make it debit. Now let us take a look on the subsidiary journal. We purchased the quantity from the parent, so we have 42,000 times 31. So we debit inventory by $1,032,302 and credit cash. Then we make sales for 46. So we make two journal entries, one for the selling price and one for the cost of price. And here we debit cash, accounts receivable, credit sales by the selling amount, and debit cost of goods sold, the credit inventory by the cost. And now you might wonder, which account I should take it from here for the consolidation? It's this one. So now I have sales credit, cost of goods sold debit, and I will make the journal entry here. We debit sales credit cost of goods sold, and this would be the journal entry. So in this scenario, we made the sale of the whole quantity to the outsider before the end of the year, so we don't have unrealized gain. So we have only two accounts, sales and cost of goods sold. Now, if we check the second exercise, we see the parent company also is buying 41,000 units for $16 each. Sold 26,000 out of them to the subsidiary for $20. But the subsidiary didn't sell the 26. The subsidiary sold only 19 out of 26. So 7,000 units, which is 26 minus 19, is still remaining in the warehouse of the subsidiary, and needs to be consolidated at the end of the year. So we need to do the journals for the parent, the journals for the subsidiary, and the consolidating entry. To make it easy for you, I'm going to use the same journal entries for the parent. I did it in the previous example, and the main journal entries for the subsidiary, but the journal entry for the consolidation should include another account here called inventory for the unrealized gain. So here is the answer. For the parent, we debit inventory credit cash by the purchase. We purchased 41,000 times $16. I got it from here, 41 times 16. And we sold 26 for $20. So we debit cash, accounts receivable, credit sales. Again, I put it here in bold. And then we debit cost of goods sold, the credit inventory by the amount. How about the subsidiary? If you can see, it's the same accounts we did in the previous example, but here we change the number of units and the price. So we purchased 26, we sold 19,000, and the 7,000 is still remaining. Now, as I said, we will take here the consolidating. We take sales 520, which I got it from here, 520. But you might wonder, why didn't I take the cost of goods sold 380 from here, as I did in the previous example? Remember, I will take it, but the 380 is for the 19, not the 26. So I took here 19,000 times 20, 380, but the 7,000 still came from the parent for $16, and I haven't sold them yet. So I take the $16 as the cost price for the 7. So here we will have two components for the cost of goods sold, the 380 and the 7,000 times 16, because they still remain in the inventory. And the last one, the unrealized gain, which we put it in the inventory, we have 7,000, and the gain in the 7,000, the difference between the selling and the cost price $4, we get $28,000. In the last exercise, we see a parent company is making sales to the subsidiary company, and the subsidiary company is making sales to the parent company. If the parent company is making sales to the subsidiary, we call it downstream transaction. If the subsidiary is making sales to the parent, we call it upstream transaction. And this is what we see it here. We see the Palace, which is the parent, they sold the inventory for 118, and the subsidiary sold inventory for 360. And the balance sheet of the parent company contains 104 inventory from Sun. The inventory cost 64. So here we see, it seems we have gain of 40,000. In addition, the subsidiary company has goods for 31,000, but the cost 18,600. So I think the difference is 11,400. And then we see here the company, the subsidiary, made net income 75,000 and dividends 15,000. And please remember, the ownership here is 70%. So we will see an NCI of 30%. We need to do the consolidation entry, which is similar to what we have done in the previous chapters. But we need to add another journal, which we did it in this chapter, where we debit sales, credit cost of goods sold, and unrealized gain. And then we need to do the consolidated worksheet. So here is the balance sheet that came out from the parent and the subsidiary together. Remember, here we have common stock from the subsidiary, 133, and retained earnings, which includes net income and dividends. So the 232, it's after the net income of $75,000 and the dividends $15,000. How can we make the consolidation? If you remember in the previous chapters, we used to say debit common stock, debit retained earnings, debit income from the subsidiary, debit NCI, credit dividends declared, investment in subsidiary, and NCI in net assets. So we take 133 from here, from the subsidiary account. I will come back to the retained earnings, by the way, because we don't take the 232, we take the beginning balance of the retained earnings, which is 232, but we subtract the net income and we add the dividends. Why? Because I'm going backwards. We used to say beginning balance plus net income minus dividends equal ending balance. Now my ending balance is 232, so I go backwards. I subtract the net income and I add the dividends to get the beginning balance. So the beginning balance here is $172,000. But we also take the $75,000, which is the net income, and distribute it between the parent that will take 70%. So 75,000 times 70%, we get 52,500. And then 75,000 times 30%, we get 22,500. And then, as I said, the parent had the balance, which is here. The subsidiary had a balance of 31,000 and the cost 18,600. The difference between them is the net income that unrealized net income that I should subtract from the original amount of net income. And there is also another balance that comes here in the parent company, which is 104 minus 64. However, those 40,000 should be distributed between the parent, which will take 70%, and the subsidiary, which will take 30%. So we take here 104 minus 64 times 70%, and here times 30%. And then we subtract them, we get the income, which is the net income before the unrealized gain in the downstream and the upstream. And the same thing for the net income for the NCI, we subtract the upstream, and then we get the final balance sheet. The dividends is given, which is 15,000. The investment is given, which is here 215,100. And then the NCI, we get the total amount of common stock and retained earnings, and we multiply by 30%. And then we add the portion of the net income to the NCI, and then we subtract the portion of the dividends, which is 15,000 times 30%, and the 104 minus 64 times 30%. When we subtract the last two from the amount, we get NCI 97,500. I know there is a lot of calculation here, but I appreciate your patience, and I encourage you to stop my video, go back to the numbers, and try to recalculate. Then we need to do another one for the sales. And here we have the sales, which is coming the total amount of sales, 118 plus 316. I got it from here. 118, the sales, from the parent to the subsidiary, and 316 from the subsidiary to the parent. I add them together. So here we have debit sales, total sales. Then debit inventory, credit inventory for the unrealized gain, the difference 14,000, and here the difference 12,400. So we get 52,400. And for the sake of the convenience, you can subtract both of them to get the cost of goods sold. And once you finish, you can go here to the balance sheet, and you will plug in the differences. This should be credit. Okay. So here we put the amount for the inventory, the amount for the investment. We subtract them, we get the balance here, 974,600. Then we remove the common stock and the retained earnings of the subsidiary. So we end by the common stock and the retained earnings of the parent. And then we have NCI, and this will give us equal balance in the balance sheet. Again, I hope you find this short video useful on how to explain the intercompany transaction and the reflection on the consolidation entry and the financial statements. In the coming video, I will take more comprehensive exercises that will talk also about the intercompany transaction in the area of inventory. Feel free to reach out if you need any help, and I hope you enjoy the lesson this time. Thank you. Bye-bye.